The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to Nova's presentation of Automatic Enrollment after Secure 2.0 with Craig Hoffman. Before we get started, I'd like to point out the panel that's on the top right-hand corner of your computer screen. You will see a drop-down section for chat. This is where you're going to enter in any questions that you may have for Craig. Feel free to submit your questions at any time, but please keep in mind that the Q&A portion of this webinar will be held at the end, and he will answer as many questions as time permits. If time runs out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right below chat, you will see the handouts drop down. Here you will be able to download today's material. If you're with us today to earn continuing education credits, please be sure to stay until the end to fill out our pop-up survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirement. To view any webinars you may have missed in the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us today. I would now like to introduce Nova's attorney and senior consultant, Craig Hoffman.
Thank you, Yvette. Hello, everybody. Good afternoon for those in the middle and eastern part of the country, almost the end of the morning for those out west. Welcome to Automatic Enrollment. But the information, the general disclaimer, this is general information. Don't take it as personal tax advice. Consult your own attorney or accountant if you need personal tax advice. CPAs, I think this is Texas CPA. This is our provider number. Be sure to register and complete the survey at the end. This is me. I know, once again, there are a lot of familiar names I saw on the registration list, so many of you have known me for some time. And we did a webinar last week, and I can't help but once again give the best part of, well, not the best part of my life, but a big addition, and we've had for the last 2 years. Fergie, she's actually sitting under my feet as we speak. Hopefully a FedEx driver won't show up, or otherwise you may get to hear Fergie before the webinar is done. But in any case, let's move on. So this is what we're going to do today. Give some background about automatic enrollment, talk about how Secure 2.0 will make these arrangements much more common. We'll go through in detail what Secure 2.0 requires, including qualifying as an eligible automatic contribution arrangement. And we'll go through what is required to be an EACA. Then we'll discuss QACA arrangements. And if time permits, we'll talk about the going hand in hand with Secure 2.0 mandate is a more liberal method of correcting implementation errors that occur in conjunction with an automatic enrollment or automatic escalation plan. And we'll finish on a high note with at least a little good news, a potential tax credit for smaller employers. Moving on. So what is automatic enrollment? It's basically the flip side of affirmative enrollment. When I first came into business, the idea is a participant had the option to make an election to forego cash and have it contributed to the plan. That was an affirmative election. Around, I guess, late 90s, some economists and behavioral scientists suggested you get better participation if rather than having to have an affirmative election, it'd be a negative election. You negatively elect out, otherwise you're in. And over the years, this provision has been lauded as for many reasons, and it's now come to be known as an automatic contribution arrangement. And certainly at any time the participant has the option to make an affirmative election and thereby decide for himself or herself how much they want going in the plan. The main benefit of automatic enrollment, and why Congress is pushing it and behavioral scientists, is it encourages greater savings rates by participants, particularly lower income employees, as well as younger employees. It encourages better participation and therefore better retirement security. And if you're in a plan that has ADP or ACP testing, the greater participation by rank and file non-highly compensated employees should also make it easier for the highly compensated to put more away because they will not fail or fail as badly their ADP test. On the downside, it's easy to make mistakes in administration. And frankly, that's been the main reason many employers chose not to add automatic enrollment, for fear of messing something up along the way and having to correct it with employer contributions. That's why, again, we'll talk about the new correction facility. That is meant to ameliorate some of the downside of making a mistake. There's also concern about how much is the right rate, default rate. And many are saying that the 3% common default rate to begin with is too low, and participants might believe that that's all they need to do. There's concern about participants who don't direct the investment of their account and end up in investments that are not the right ones for them. And at the end of the day, there are higher matching contribution costs for the employer, assuming there is greater participation. Now, that may not be such a bad thing, but it depends on the employer's perspective. In any case, Congress in 2006 embraced the idea of automatic enrollment by trying to put some sweeteners, if you will, out there to encourage employers to add this feature to their plan. It's hard to remember, but back before PPA 06, there was concern that many states have laws saying you cannot garnish, i.e. deduct from an employee's paycheck for any benefit unless the employee affirmatively elects to grant you that deduction. And there was a question whether ERISA superseded those state laws. Congress put an end to any discussion in PPA 06. They created the QACA. They created the EACA with some additional benefits if you qualify as an EACA. And then they directed DOL to come up with regulations for qualified default investment alternatives. That too was felt as discouraging. Employers were worried that they would have fiduciary responsibility for investing these automatically enrolled employee accounts, because if the employee wasn't savvy enough to sign the form in the first place, he or she is probably not going to direct their account. So we got the idea of QDIs, and that was now 17 years ago, and look how far they have come. They are ubiquitous, but it's hard. These were welcome improvements in PPA 06. So by the close of PPA 06, we were left with basically three types of automatic enrollment arrangements. The two statutory versions are the EACA, which if you meet certain requirements, you get the benefits of a later testing date and the ability to get small accounts out of the plan for people who didn't want to be there in the first place. You could also be a QACA type of automatic contribution arrangement, which is basically a safe harbor plan that gives you a free pass on your ADP, ACP testing. All QACAs are EACAs, but not all EACAs are QACAs. Say that 10 times fast. But the idea is there are two statutory constraints, if you will, and everything else, because there's nothing that says you've got to be in an EACA, nothing that you say is you got to be a QACA just to use automatic enrollment. At least that was the case. Going forward, For plans subject to the Secure 2.0 mandate, they will need to qualify as an EACA. So that's no longer going to be an option. Basically, all new 401k plans will have EACAs as part of their design. And what did Secure 2.0 do? Well, in 2025, Congress said enough of dallying around. We believe this is a really good idea, get savings rates up. So for plans established after December 28th, 2022, those plans will need to include automatic enrollment as a mandatory design feature, and it will have to qualify as an EACA. Now, 2.0 was passed late in 2022. This mandate is in 2025, seemed like a long way away. Well, now it's February of 2024, and I think perhaps we learned something from rushing to comply with the long-term part-time employee proposed regs. It's never too early to start getting ready for this new requirement. And I very much recommend you reach out to record keepers on your plans and the like, because there may be differences in what record keepers can support and how their designs may have to work. And it's certainly prudent to begin that process sooner rather than later. Under 2.0, for those subject to the mandate, there is a minimum schedule of default contribution rates. During the first year of participation, it's got to be at least 3%, but no more than 10. And beginning with the second year, it must go up by 1% each year until it eventually reaches 10%. And the increase is effective after each completed year of participation. I'll come back to that in a second. So the endpoint for the auto escalation must be at least 10, but can go as high as 15%. And remember, all along, the participant at any time can make an affirmative election and change what the default, change from the default contribution rate. Now, one of the, some of the feedback I've been getting over the last year and a half since this was passed is this auto escalation is going to be a royal pain in the neck. And that's one of the things I was alluding to. I've heard tales that not every record keeper is in a position to deal with auto escalation. So is there a way to avoid that? The answer is yes. Start at 10%. It's a high number, sure. But by starting at 10%, you don't have to go any higher. You don't have to go any lower. And if a participant doesn't like it, they can make an affirmative election. So one thought to be thinking about when you talk with clients and the like is, should we just go ahead and bite the bullet and go straight to 10%? The new mandate only applies to plans established after December 28th, 2022. There has been some question, what does it mean to establish a plan by the December 28th of the year? What it means to be established on or before December 28th, 22. Notice 24-2, IRS Notice 2024-2 gave us some guidance. It was released, I think, on right around Christmas time, right before Christmas. And what it says is a plan is established on the date the plan terms providing for the cash or deferred election are adopted. It doesn't matter when the cash or deferred election is effective, it's established when it's adopted. So you could have established a plan on December 15th of 2022, which began elective deferral contributions on January 1st. That plan would be grandfathered because it was established in December of 2022, 15th, before December 29th. Notice 2024-2 also clarified a question many of us had with regard to how the mandate the grandfathering provision would apply in conjunction with a merger or a spinoff from a grandfathered plan. And the notice provides that if both grandfathered plans were, if both plans being merged were grandfathered, established before December 29th of 2022, then the ongoing plan remains grandfathered. However, if a grandfathered plan is merged with a plan that was established after December 28th, then the ongoing plan is subject to the mandate. You lose the grandfathering, except for one situation, and that is if the merger of the two plans is in conjunction with a asset acquisition, corporate transaction, a 410B6C transaction, which invokes the coverage rules and the transitional period when you have that. If the merger is as a result of that transaction and the merger takes place during the 410B6 transition period and the grandfathered plan is designated as the ongoing plan after the merger, then you're still grandfathered. So one comment on that is I think you need to pay more attention to designating what is the ongoing plan in conjunction with planned mergers and the like on a going forward basis. If you work in mergers and acquisitions and the like, I'm not sure we really were that concerned about it in the past, but now there is reason to be. In addition, notice 2024-2 tells us if a grandfathered plan spins off a plan, it retains its grandfathered status and is exempt from the new mandate. So that's probably clearly, obviously, the largest exemption under 2.0 is for plans established before its enactment date. But in addition, there are some other exemptions from the mandate. Simple 401k plans are not subject to this. Church and governmental plans are not subject to this mandate. And then two categories of exemption that are sort of transitional floating. The first is for new entities. If the entity has not sponsoring the plan has been in business less than 3 years, then it's exempt from the mandate until it gets 3 years old. Now, we don't know what exactly that means and notice 2024-2 didn't address this. If a new business is formed July 1 of 2025, sets up a calendar year K plan in 2026, must automatic enrollment begin by July 1st of 2028, literally 3 years to the day after it was established, or do we get to wait to the next plan year? In my ever so humble opinion, I wouldn't mess with this rule, this exemption, unless there was some really good reason. I think if you're setting up a new plan after the 28th of 2022, December, then I think it's more prudent to go ahead and bite the bullet during the first 3 years rather than having to try and roll it out later. The other exemption is for small employers who normally employ no more than 10 employees. And that, in this case, the mandate, there is a strict direction that the mandate will apply to a small employer after the first plan year beginning after the close of the first tax year in which the 10 employee threshold is exceeded. So it's 1 year after the close of that first tax year. What's more important, though, is we are not sure whatsoever what normally employing an employee means. There was no guidance in 2024. I mean, I can speculate, you can speculate. I really don't know, and I'm hopeful we'll get more guidance than the very skeletal guidance that was contained in the recent IRS notice. So that's what 2.0 mandates, but then it also mandates that you've got to be an eligible automatic contribution arrangement. And EACAs can be designed differently for plans not subject to the mandate and plans that are subject to the mandate. Plans subject to the 2.0 mandate must allow participants to make permissible withdrawals during the first 90 days they've been auto-enrolled. And it must provide that participants who were auto-enrolled who failed to give investment direction must be invested in a QDIA. Now, I think every plan today, well, I shouldn't say every plan, there are exceptions, but I think the vast majority of plans have QDIA, so that's not an issue. But many plans, even those that qualified as EACAs, don't allow permissible withdrawals because they're not subject to the 2.0 mandate. And that's fine, but what I'm leading to is we all need to get more familiar with how those rules work, because it's not going to be an option anymore. It is a mandatory part of the design for plans subject to the mandate. The benefits of being an EACA. Well, as I said, you get an extended period to do your ADP and ACP test and correct by making a corrective distribution and thereby avoiding the 10% penalty. Normally, it's a 2.5 month deadline. It'll be a 6-month deadline if you qualify as an EACA. The EACA has to cover everybody in the automatic contribution arrangement in order to get that 6-month deadline. And I think for secure 2.0 mandated plans, that's going to be required anyhow. If you have a pre-mandate plan, you need to make sure you're covering all people in the plan, or otherwise you don't qualify for the 6-month deadline, 6-month extension. In addition, as I alluded to, the plan may permit in-service withdrawals by newly eligible participants who have been automatically enrolled. Mandatory for the Secure Act plans, not so for those grandfathered. In addition, so the EACA has to meet those requirements. Within the EACA, how do we do that? Well, at the top of the list, to qualify as an EACA, you must have a uniform default rate applied to everybody in the automatic contribution plan. Now, plan for this purpose is defined as under the 410 coverage rules, where we have mandatory disaggregation of within a single plan. So that, for example, if you have a multiple employer plan, the uniformity is applied separately to each unrelated employer group. Or if you've got a plan that covers collective bargaining employees, you could have a different uniform default rate for them as compared to everybody else. The uniform rate, however, doesn't really need to be uniform. There are some exceptions, so it's okay to have a 3% default rate for those who've got 1 year of service and a 4% rate for those who have 2. That's not uniform, but it varies based on years or portions of years since the first contributions were made. Keep in mind that if you have a QACA, the minimum default contribution percentage must be satisfied for the entire year. So you can have escalation, if you will. If you roll out an EACA to an existing K plan, pre-existing elections don't need to be reduced, so they can be non-uniform. And if your uniform default percentage would cause somebody to violate the 402G limits or the 415 or the 4017, A17 complement, likewise, you can reduce their minimum default percentage. I don't see that happening too much there. So it's got to be a uniform default rate. Participants must receive notice. The notice has got to be accurate and comprehensive, written in a manner to be understood by the average employee, and must include a host of information. To begin, The EACA notice needs to contain the same information as would be contained in a safe harbor 401k plan notice. The EACA regs actually cross-reference to the safe harbor regs and say include that same information. So we're talking about the contributions made to the plan, the type and amount of compensation that may be deferred, withdrawal, investing provisions. So you start with your safe harbor content. Then, in addition, you need to describe the default elective contribution rate, tell the participant he or she has the right to make a different affirmative election, describe to them how contributions will be invested if they choose not to direct their own investments. And it must describe the permissible withdrawal features and procedures to avail yourself of that, assuming you've got one. If it's a secure 2.0 plan, it's going to have permissible withdrawals, so this would have to be part of that. And once again, the notice timing is pretty much the same as is the case with regard to safe harbor notices. The annual notice must be given a reasonable period of time before the plan year begins, which is based on the facts and circumstances. But if you give the notice at least 30 days and no more than 90 days before the beginning of each plan year, it's deemed to be given within a reasonable period of time. For newly eligible participants, they must, again, facts and circumstances, receive their initial notice a reasonable period of time before the first automatic enrollment contribution is deducted, with the idea the participant needs to have enough time to make an affirmative election and overrule the default contribution that would otherwise be made. And so the IRS says if the initial notice is given at least no earlier, than 90 days before the employee becomes eligible and no later than his or her eligibility dates, this is a newly eligible person, it's deemed to be timely. And in fact, you can even give the notice after the employee becomes eligible, as long as he or she has an opportunity still to make an affirmative election before the first payroll to which the automatic deduction is going to be applied. Notice must be in writing. It can be delivered electronically. And as we're seeing, there is a great deal, as we will see, a great deal of redundancy between the safe harbor notice, between the EACA notice, between the QDIA notice. And so it is permissible to combine all of those notices into a single notice. And I think many plan sponsors, in fact, do that as well. And the IRS has provided a handy dandy little sample. I'm sure there are many more you can Google and find if you're interested in doing that. So that takes us to permissible withdrawals. Again, mandatory for 2.0, optional for other EACAs. But the idea, it permits a newly eligible employee to, who has had a automatic contribution deducted from his paycheck, to say, stop, I didn't want that, give me my money back. And this was part of PPA 06, and it was to counter the problem that disincentivized folks from, discouraged employers from having the plan, because without permissible withdrawals, if an employee wasn't reading the notice, money goes into the plan in the first paycheck, and the employee says, I don't want that there, you can't give it back to him because of the in-service restrictions on elective deferrals, in-service distribution restrictions. Permissible withdrawals allows a distribution to be made without violating those restrictions. And the plan is better off for it from a standpoint, it doesn't have a bunch of little accounts driving up the cost. And these days with the new rules for determining plans subject to an independent audit based on people with account balances, it may help reduce the probability that the plan might be subject to an audit. So there is benefit to it. It's just a little bit of a pain in the neck to administer. The employee's election has to be made within 90 days of the date on which the first elective deferral is taken from their income. The plan, if they wish, can set a shorter period of at least 30 days if they want to. It's got to be at least 30 and up to 90. And then once the participant does make the election to get the withdrawal, that election has to be effective no later than the earlier of the first pay date. That is at least 30 days after the election, or, and this or is going to be the more common one, assuming you get paid more frequently than month day, the pay date for the second payroll period that begins after the date of election to withdraw is made. So the idea is, I say, no, stop this in this payroll period. You can still take money out the next payroll period, but by that third one, if you will, then it must be effective. Permissible withdrawals, you need to provide notice. Again, it's just included as part of the EACA notice. Permissible withdrawals, what are the tax effects of asking for this money back? Well, if you made a pre-tax standard type of elected deferral, then the distribution amount, your elected deferrals plus earnings will be taxable to you in the year of the distribution, which in most cases is going to be the same year. You could have a circumstance where somebody enters the plan December 1 and gets and asks for the withdrawals in January of the next year. Then you're going to have two different tax years, if you will. And it's reported on a 1099-R. So it's reported both as an elected deferral in the W-2, but then as a distribution in the 1099-R in the year of the distribution. If the contribution was a Roth elected deferral, then the Roth amount, the amount actually contributed, is not taxed again, but the earnings on that amount is taxed in the year, are taxed in the year of distribution. So, and a permissible withdrawal is not subject to the 10% early withdrawal tax. You don't need spousal consent. It's not an eligible rollover distribution, so it's subject to the voluntary income tax withholding, typically 10%. A question that arises is, can you charge a fee for a permissible withdrawal? It's got to be made in accordance with the plan's ordinary procedures for making distributions. And it doesn't have to be made within that 90-day period. If the plan is not using a QDIA, which will not be the case for the vast majority of plans, it's okay, according to the EACA regulations, to charge a reasonable fee for processing. But if the plan is using a QDIA, the DOL regs expressly prohibit imposing a fee on a permissible withdrawal made during that 90-day period. And I've seen some confusion out there. I've even had some debate with some of my colleagues over the meaning of this DOL reg that I'm citing to you. And what I'm citing to you is this subparagraph that says the prohibition on fees doesn't apply to fees and expenses charged on an ongoing basis for the operation of the investment, such as investment management fees, distribution and or service fees, 12B1 fees, legal accounting, etc. Well, Craig, that says, this is an administrative expense or a distribution fee. No, that's not what they're talking about, because they're talking about fees that do not vary based on the decision to withdraw. And that's the last part of this sentence. You can charge those fees as long as they are not imposed and do not vary based on the decision to withdraw money out of the QDIA. And I believe that that is expressly applicable to permissible withdrawals. Others may disagree. I'll leave that to your own consideration, but I don't think you can. A person who makes a permissible withdrawal must have the right to make future contributions. They can't be banned for life because of the withdrawal. If there are any matching contributions that were made relating to the permissible withdrawal that need to be forfeited, and they are not taken into account for the ADP test, or if it's a forfeited match, are not counted in the ACP test. So permissible withdrawals are coming. We need to be prepared for that, which many plans, I would guess, polled around our office, and I think less than a third had permissible withdrawals, but that was very anecdotal. So you've got to be in a QDIA, and we've had the QDIA rules around for some time, but what it does is generally, your plan's fiduciary is responsible for investing the assets. However, under 404C1 of ERISA, if the participant can direct and control the investment of the assets in his or her account, the fiduciaries are off the hook. And there's a long, detailed set of regulations dealing with what you've got to do to get protected as a fiduciary from decisions made by plan participants. Fiduciaries always retain responsibility for prudently selecting and monitoring the designated investment alternatives that are made available to participants to make sure that they are prudent, generally speaking. But again, as part of PPA 06, we got the rules for qualified default investment alternatives. And again, these were welcome, but they too have detailed requirements that have to be satisfied. Again, I've already made this point several times. If you're in a 2.0 plan, you've got to have the QDIA. One thing, though, I didn't make and is relevant here is what happens if you've got a plan that doesn't have directed investments? I mean, what if it's, an old-timey balanced forward pooled plan? Or it's not daily valued. And the question is, if there are still a few of those plans out there, and it's not clear how this mandate to offer the QDIA is applied to a plan that doesn't have directed investments. Another question, another one that was not answered in the IRS guidance, and it's interesting. It will be in the IRS's court to determine how to apply this absent, because it's not really what is a QDIA. It's a question of what do you do if you don't have it? And maybe the IRS will say you've got to have it. I don't know. So QDIAs have been around for a while, but we'll go through some of the requirements because, again, we need to be up to date on this. So there are 5 types of acceptable QDIs, and in popularity, there are really only 2, maybe 3 to speak of today. At the top of the list, and clearly the most popular today, is a life cycle or target date fund, where the makeup, the asset mix, is an appropriate mix of equities and fixed income investments that are appropriate for the specific participant whose monies are being placed in this investment based on that participant's age, life expectancy, or normal retirement date, what they're targeting to retire. And so the idea is a target date fund. If you invest in a fund that matures in 2045, 20 years from now, it's going to start out with a lot more equity today and gradually over time increase the mix so there's more fixed income, less equity. Standard investment theory that you want more conservative investments as you get closer to retirement. The second is a balanced fund, again, a mix of equity and fixed income, but rather than it being based specifically on the age of the participant, it's based upon the demographics of all plan participants on the whole. So I have not seen this used much. The problem is, it's going to be good for people right in the middle, if you will, but it may be too aggressive for older participants and too calm, tame for younger participants. So we don't see that much. The third is a managed account, which the investments are managed much like a target date fund, but it's done by a 338 investment advisor with discretionary authority. And this managed account option is, to be honest, I did not see much of that until recently. Over the last 3 to 5 years, there are a large number of record keepers out there that are pushing it as the best thing since sliced bread. The idea is you take into account not only the participant's age and target retirement date, but other personal characteristics of the participant in managing the account. Do they have other assets outside the plan? Do they have a pension, a defined benefit pension from some prior employer or in the military? Or what is their risk tolerance? And the idea is this gives a better investment return, but at a higher cost. At least that's how it's touted. Now, there have been litigation where, the plaintiffs' attorneys have been suing trustees who brought on managed accounts, saying you're really getting nothing different than a high-priced target date fund, and you were imprudent in selecting it. I'm not here to tell you. You can Google the current literature, and there's a lot out there promoting why this is good. There's one option that many record keepers are promoting is that you stay in a target date fund till you reach some designated age, maybe 45, maybe 50, maybe 40. But at that point, it's more appropriate to have a managed account that can take in your outside circumstances. I'm not Fred Reish, so I'm not going to opine on the prudence of it. I'm just telling you it is available. And then the last two, grandfather money market funds or stable value. There were some QDIAs before the regs that went that way. I don't see much of that around. You also have the option for the first 120 days after the money is put in the QDIA to keep it in a stable value fund where it maintains its principal value. The theory being the participant may want to withdraw it or may want to transfer it to an affirmative fund. And you don't want any losses to occur before the participant takes control. This reiterates the no penalty requirement. Enough said, I think I was pretty clear. The one point to be made, that's during the 90-day period, first after the investment in the QDIA. After that, after that 90-day period, you can charge the same fees for transfer or otherwise that would be charged to participants who affirmatively elected to invest in the QDIA. You need a QDIA notice. If you don't give the notice, you don't have protection. Should be given to everybody. Same timing rules, at least 30 days before, initially 30 days before you're eligible, or as of the date of the first investment. 30 days before the date of the first investment. Second, for the annual notice, a reasonable period of time of at least 30 days in advance of the plan year. It doesn't say an outer window. Once again, there's no reason not to tie in the QDIA notice with the QACA, EACA notice as well. Regular rules, understandable, accurate, and comprehensive, can be given either with the IRS or DOL electronic delivery rules. The QDIA must describe the circumstances under which assets are invested. In the QDIA, describe how if there's an automatic enrollment feature, how that's working, the investment objectives and characteristics of the QDIA, the ability to transfer out without financial penalty during that 90-day period, and where they can get additional investment information. The fiduciary protection comes if you give the notice, they're in the QDIA, the assets, the participant must be given the opportunity to actually make an affirmative election and chooses not to. And the plan must offer that participant who declined to make the affirmative election, the plan must have a broad range of investment alternatives from which to choose that vary materially as to risk and return characteristics. That's the same mandate to meet the regular directed investment requirements. So most plans should satisfy that without any problem. And you've got to be able to move the funds out of the QDIA consistent with the plan terms, but at least quarterly, no less than quarterly, without penalty. All right, we're running out of time, and I haven't run out of material here, but let me quickly hit QACAs. Again, safe harbor plan, all the benefits of a safe harbor 401k plan, but has automatic enrollment. So you do qualify as an EACA, you are deemed to satisfy the ADP ACP test, and you can satisfy the top-heavy exemption if the only contributions being made are elective contributions, safe harbor contributions, and matching contributions that satisfy the ACP safe harbor. That's 416G3H, if I'm not mistaken. How's that for a good site? Keep you awake here at the very end. There's a minimum level of automatic enrollment. The participant must be allowed to opt out, and there's a modified safe harbor notice that basically gives the automatic enrollment information. So you talk about the safe harbor contributions, the general safe harbor information, and then you must also describe what the default contribution rates will be. And for a QACA, there is a prescribed hierarchy where you must begin at 3% for the first year of participation and go up 1% each year thereafter, topping off at 6%. Now you can go higher than 6%, but you don't have to be a QACA. However, if you are subject to the Secure 2.0 mandate, then you will have to auto-escalate to at least 10%. And so once again, the default percentage cannot exceed 10%. So although a secure automatic contribution arrangement can go up to 15, if it's a QACA, it can only go to 10. And bottom line is you can avoid auto escalation by setting everybody at 6% if it's a grandfathered plan, or 10% if it's not if subject to the mandate. One thing to look at, the first year of participation is defined as the year you start plus the next full plan year. So you just need to administer that way. So the person's first is at the 3% deferral rate for anywhere from 13 to 24 months before then they go up plan year by plan year, 1% more each year. You don't have to provide you don't have to auto-enroll participants in the QACA if they were eligible before the QACA was installed and they had an affirmative election. If the affirmative election of 0 would be fine, but if they chose not to make any election and just were not enrolled because they didn't make the affirmative election, then you do have to enroll them in the QACA. The QACA safe harbor contribution can be either a 3% non-elective or a slightly less rich matching contribution than the normal safe harbor. It's dollar for dollar, up to 1% of pay, and then 50 cents on a dollar of deferrals between 1 and 6. So you would get somebody maxing out at 6% will get 3.5% of pay, whereas somebody in a non-QACA matching safe harbor would get 4%, 0.5%. You save 0.5% of pay, whatever that is worth. The QACA contributions are only required for eligible non-highlies. And unlike regular safe harbor contributions, QACA safe harbor contributions can be subjected to a 2-year cliff vesting schedule, which might be kind of nice from a standpoint of you have high turnover. The only concern is that top-heavy exemption that I referenced requires the only contributions being made must be the QACA and elected deferrals and safe harbor contributions, matching contributions that fit within the ACP safe harbor. So if you have forfeitures, you can't allocate them like a profit sharing contribution, because if you do that, you're going to blow your top-heavy exemption. So if you have forfeitures of QACA safe harbor contributions, you got to use them to pay expenses, reduce the employer contribution, or if you've got a discretionary match, you can fund the discretionary match or reduce the fixed match. So they're officially not QNEX or QMAX, but they are subject to the withdrawal restrictions and pretty much treated the same way, but for the vesting provisions. All right, we'll quickly finish up here. As many of you know, there has been on the books an IRS in EPCR's program that allows implementation errors made in implementing an automatic enrollment auto escalation to be corrected in a very liberal fashion. Essentially, you just put the person back in the plan and make up any related matching contributions. That would have sunsetted, but for Congress acting, and so we now have this available. And notice 2024-2 does give us some guidance in this area. Excuse me. You correct this implementation error simply by putting the person back in the plan and starting the correct salary reduction contributions pursuant to the default auto enrollment amount. And you do then have to make up related matching contributions and earnings. But if there are no related match, then you're good to go with just putting them back in. When do you have to put them back in? You have to put them in by the earlier of. And it essentially comes down to whether the participant tells you, hey, you made a mistake and didn't withhold. If the participant doesn't notify the plan of the mistake, you must correct it no later than 9.5 months after the end of the plan year in which the implementation error occurred. And that 9.5 month period is by design to coincide with the due date of the 5500 for that prior year. This comes from ASPA. When I was at ASPA and General Counsel, we lobbied the IRS for this rule, saying that that's when these errors are caught. Give us that until then. And that was in the old EPCRs. Now it's even better. It's codified, so it's not going to be sunset unless Congress sunsets it. So you normally have 9.5 months unless the participant says, hey, you missed me. And then you've got to begin correct deferrals no later, and I love this wording, the first payroll date occurring on or after the last day of the month following the month in which the employee notifies the plan sponsor of the implementation error. So the idea, you notify the employer, hey, I've got an error this month. I've got the next month, and it's the first payroll date after the last date of the month following the month in which the employee notifies. So I've got at least one full month, maybe a little more, and the first payroll date after that full month is when we've got to put them in if the employee notifies us of the omission. Related matching contributions have to be deposited within a reasonable period of time after the corrective contributions begin, according to Notice 2024. That's a question of fact and circumstances, but if they're deposited basically within 6 months following the date correct deferrals begin, it's deemed to be reasonable. And lastly, it's at least one bit of good news. This was from 1.0. If you are a small employer, one having no more than 100 employees who receive compensation, you have no more than 100, who receive more than $5,000 in comp. So if you do not exceed that threshold of 100 employees who got $5,001 in comp or more in the prior year, you can qualify for a $500 tax credit by including an EACA as part of your 401k plan. So it applies to a new plan, it applies to an existing plan if you add it, and the credit is available for the first 3 tax years beginning with the year the EACA was first established. Now, $500, is not a lot, but, and I know many of you have heard me use this reference before, but as my dear father would say to me, Craig, it's better than a stick in your eye. And as I often thought, what's not better than a stick in my eye, Dad? But I didn't tell him I thought that because you know what be coming next. Anyhow, I was raised in the old days. We didn't do that to our kids today. Yvette, I have reached the end of the PowerPoint. We've got a few minutes left for a few questions.
All right, you do have a couple of questions that came in. First one is, what if the plan has immediate eligibility? How does the 30 notice work?
Well, if it's got immediate eligibility, you would have to give notice on their date of eligibility. I mean, you would have until the first pay date, if you will, to make sure they get the notice before the first pay date so that they can implement that in that circumstance. At least that's my best thought on it off the top of my head. If you would like to reach out to me, by all means, feel free to do so after the fact, and I'll try and confirm that for you. Next.
All right, next one is just piggybacking on something you mentioned. They just said, just FYI, to support your statement, we are seeing a lot more often where a new plan coming in from sales is setting the auto-enrolled default percent at 10%.
Yeah, and we've talked about that at Nova, where I work, and we are likely going to go forward with that same approach. At least we have not been mandating automatic enrollment for plans up to this point. We have changed our practices for any new plans established, and we have been talking about the plans we're going back to. We'll probably set at 10, and I'll go back to what I'm hearing is there are some record keepers that literally cannot handle automatic escalation.
All right, and our last one is kudos to you. Craig Hoffman has always been a superstar and a great person to listen to regarding qualified plans.
You make me blush, folks. I appreciate the kind words. I've been doing this a long darn time. I appreciate Nova giving me a place to still reach out to people. They're a great firm. If any of you are looking for a job, we're always hiring at Nova, but I thank you for the kind words, and we will certainly have future webinars, both by me and other Nova employees, so be sure to subscribe to the Nova LinkedIn page where we generally promote these programs.
Awesome.
All right, Yvette, why don't you close us out?
Okay, perfect. Just a few reminders on your go-to panel. You're going to see a drop-down for handouts, and that is where you're going to be able to download today's presentation in PDF form. If you're not able to see this panel, you can email us and we will send you the handout. For CE credit, be sure to fill out the pop-up survey once the session ends. For any other questions, you can email us webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you so much, Craig, for sharing your time and your knowledge with us today. And thanks again to everybody for joining. We hope you have a great day. Bye.
Thank you, everybody. Have a great weekend. Stay warm. I'm not sure who to cheer for. I don't have a team in this hunt, but go both Kansas City and San Francisco. Yeah.